Okay, let's talk. This is the elephant in the room, and this is why the markets really crashed the first half of the year. First of all, inflation we know is spiking. The Fed is freaking out, and they're going to raise interest rates. I believe they're going to continue to raise rates. So that's a foregone conclusion. Rates are going up. Period. End of story. This article is a very good article. Financial Times. I make my students read the Financial Times. Not my interns, but my students at CU. But good article. She mentions there's two types of inflation, good inflation and bad inflation. What's happening right now in Europe is very bad inflation. Russia's about to shut off all the oil to Europe. That's putting Europe in a recession. That's very bad. That's a tax. As the price of energy goes stupid. And of course, as you know, Ukraine is the breadbasket for other commodities, like agricultural commodities, and that's bad. So Europe is probably going to go into a pretty deep recession. But she talks about that's bad inflation. But there's good inflation. Good inflation means when the demand stays high, companies need to invest more and buy more. And that means that if wages are going up, demand stays good. And so inflation means people are buying and there's strong demand. And that's what the article is essentially about. It's that demand push inflation. And I'm going to get into some numbers in a minute that's going to surprise a lot of people in this room. Because this is why the market is crashing right here. The media, if it bleeds, it leads. That's the truth. And consumer confidence is in the toilet. And when the herd mentality, when everybody thinks the world's going to heck in a handbasket, get me out, sell, and we end up with the worst 6 months in fact, of all the first 6 months of the year, we're in the top 3%. Only the Great Depression, 37, World War II, the early 70s, and the dot-com in 08. So it's been really bad. It's been really bad. I love this slide. I don't know where we're going, but from the looks of the crowd, it's going to be good. And then, of course, when the herd is all running toward a cliff, the ones running in the opposite direction is always crazy. Okay. Well, not according to Mr. Warren Buffett, but then that Warren Buffett is a billionaire. When everybody is selling, that's when I'm buying. That's Warren Buffett's motto. That's hard to do. When you look at your statement and go, oh. You look at your next month's statement and go, oh. It's hard to say add to the market. But anyway, it's interesting because this is the guy that made the market crash. And this is what the media was reporting. This is the head of the Federal Reserve. He's the one that decides if interest rates go up. And he decides something else. He decides if he takes money out of the system. In other words, he takes liquidity out. Okay? That's called quantitative tightening. And that is just as bad as raising interest rates. Because if there's less money in the system, that means banks become very stingy. Banks go, nope, I'm not going to give you that loan because your score's not very good. So does higher interest rates hurt the stock market? Because that's what you need to know.